Welcome again. Great to have you join us for the latest Charter Hall Direct Quarterly Update. Well, it's been a positive start to 2021. We've seen a steady return to the workplace across the country with the relaxation of rules relating to social distancing. This has meant we've been able to engage in activities and freedoms that have not been available to us for some time. It's been fantastic for me personally to be able to travel and engage face-to-face with colleagues and customers across the country. Throughout the quarter, we've been monitoring changes closely, taking careful consideration in positioning our portfolios in the best possible way. We've also considered the areas in which we can look to grow our business as opportunities present themselves. As expected, we've seen momentum in the e-commerce space. Expectations and habits of consumers are driving change to the industrial and logistics sector. With improvements in technology, there's been a switch in preference to online purchases of staple retail products. Our tenant customers, in a bid to meet this demand, have continued to seek ventures and partnerships with Charter Hall to grow and strengthen their position in the market. The online grocery market is one area that continues to see substantial growth. Charter Hall has positioned itself as an established leader with capabilities to deliver outstanding results for our partners, including quality tenants such as Woolworths and Australia Post. We are well positioned to capitalise on further opportunities to strengthen our tenant-customer relationships and fulfil the ongoing demand. Finally, it's been inspiring to see the activation of our city centres firsthand, with the hype and buzz of the return of many of our retail tenants. I hope you enjoy Stephen's update and look forward to speaking to you again soon.
Thank you for joining us for an update on the Charter Hall Direct suite of funds performance as at the end of March 2021 quarter. I'm Steve Bennett and I head up our direct business at Charter Hall. The direct business is part of the wider Charter Hall Group, which is comprised of over 500 property professionals and is ultimately responsible for managing, on behalf of our investor customers, over $46 billion of Australian real estate. Thank you all for joining us, as today I'll provide a regular quarterly update on the performance of our direct suite of funds for the March 21 quarter. As is usual, as part of these events, we'll have some guest speakers join us who will continue to provide educational material to our audience. During the quarter, we also completed many acquisitions for the Charter Hall Direct PFA Fund, Direct Industrial Fund No. 4 and the Direct Long WALE Fund. These acquisitions were in line with stated fund investment strategies and were focused on properties leased to high-quality tenants on long-term leases which promote resilience through all sorts of different economic cycles. But I will talk about these transactions in more detail later on in the presentation. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds, and if you do have queries related to your personal investment situation, we strongly encourage you to consult your financial advisor, read the product disclosure statement in full, or the information memorandum. Up on the screen right now is the agenda for today's quarterly update. You can see it is quite comprehensive and there is a lot to get through, so myself and the other guest speakers will try and get through it at a good pace. As is traditional with these quarterly updates, the first thing we'll cover off is how the funds are performing. After all, you're all invested in these primarily for the financial returns, both income and capital gains that we're able to deliver. Very pleasingly, whether the funds are historical syndicate fixed life funds or funds that are open for investment, as you can see on the chart up there on the screen, every fund is exceeding the benchmark, which is the grey bar. And this is also showing the resilience of unlisted direct property, because we have been through a global pandemic and yet largely the income and capital stability has really shone through. The next slide up on the screen is the ex-Folkestone funds. We had some feedback from the last event that investors wanted to cover these in a little bit more detail. Up there on the screen shows the returns being the blue bars since inception versus the benchmark returns. The Sydney Airport Fund had the airline quarantine contract with the New South Wales Government formally extended to 30 June 21, as well as having the ANZ debt facility refinanced at a 45% LVR. Green Square had its short-stay guests overtake long-stay guests, which is encouraging, as well as the property valuation, which is currently being undertaken for the 30 June accounts. It is anticipated that the valuation will be in line with book value. The SOP Opportunity Fund has put its property to market with the Expressions of Interest campaign recently closing. Investors will be updated once this is further progressed. For the Wollert Fund, it had strong sales for the quarter, reflective of the broader stimulus in the residential markets. The Plumpton investment is currently break-even, with the investment performance impacted by the slow sales in late 2018 and 2019. The table up there now on the screen shows the unit prices of all the core direct suite of funds. Pleasingly, every single fund remains above the dollar, and all the funds, whether they're open or fixed life funds, will have valuations undertaken at 30 June 21. It should also be remembered, particularly for the funds that are open for investment, that on a daily basis we will amortise a portion of the acquisition costs, the largest being stamp duty. So it is quite normal during the quarter and during the half year for unit prices to slowly trend down as that amortisation is booked through the unit class. Up there on the screen shows the valuation's key points as well as investor distributions. And we know most of our investors are focused on not just the income, but the capital returns that direct property can give. We will undertake valuations from independent firms across the suite of funds at 30 June, as well as undertake at any time valuations where we believe that the value has moved in a material way. In fact, for the Direct Industrial Fund number 4, it's had approximately 30% of the portfolio valued at 30 April. On the income side of things, the team are very busy at the moment undertaking property level budgets, overlaying the debt structures and fund level assumptions such that we can provide our investors in the June quarterly report, which you should receive at the end of July, with the distribution guidance for the next 12-month period. The slide you can see up on the screen talks about the Direct Industrial Fund number 3 and number 4 liquidity events. DIF 3 is a syndicate, meaning that it has a fixed life and will not necessarily continue indefinitely. I'm pleased to say that we received less than 10% of redemption applications, meaning that this fund will roll over for another 3-year period. For DIF 4, it's a little bit different. DIF 4 is one of our open-ended funds, meaning every 5 years there's a major liquidity event. That review event is coming up in November this year. We will simply mail investors and advisors forms, and you put in what you want to do. The fund will definitely continue, so those investors who we expect will be the vast majority who want to stay invested will absolutely be able to do so. In terms of when those investors who want to be redeemed will receive their payment, it is likely to be in the first half of 2022, and because we believe in fairness and equity, those redemptions will be processed only after the 31 December independent valuations are undertaken. So this now brings me to the part of today's quarterly update where I'll get into a little bit more on the detail on some of the open funds. The first fund which I'll talk to and showing up on the screen right now is the Maxim Property Securities Fund. You can see here it delivered a strong return over the 12 months of 43%, but I do want to emphasise that past performance should not be expected to continue into the future. The benefit of the Maxim Fund is that it's actively managed. It means it relies on the expertise of property securities portfolio managers to select the stocks which they believe will generate the highest returns. You can see here on the next slide, this is the performance of the Maxim Fund versus the benchmark over the last 5 years. It shows an initial $10,000 investment at the start, with the blue line representing Maxim and the grey line being the benchmark, and as is clear to see here visually, the Maxim performance has far exceeded the benchmark returns. That is one of the benefits of active management. So that chart on the Maxim performance versus the benchmark is a great segue to our first guest speaker today. I'll shortly be introducing Jonathan Kriska to come join us, who's the portfolio manager of listed securities at Charter Hall. Jonathan is one of the portfolio managers of the Charter Hall Maxim Property Securities Fund, and I'll ask him a few questions on how that fund works shortly. He brings with him over 20 years of experience in funds management, stockbroking, most of which has been focused on the listed property sector. His career also includes roles in equities research, corporate advice, asset management, product development, and capital raising. Please welcome Jonathan. So thanks for joining us, Jonathan. I've just given an introduction highlighting how experienced you are. And look, I might kick off with one of the questions I often get asked, which is, why might an investor consider any investment into the A-REIT sector?
Thanks, Steve, and look, good morning, everyone. As we know, commercial property is a great asset class which has the opportunity to deliver investors some solid income levels. And I guess the A-REIT sector gives you a sort of an easy way to access that, given A-REITs trade on the ASX on a day-to-day basis. So when we think of some of the key reasons why you want to invest in A-REITs, clearly there's that liquidity, that daily liquidity you get. Also, the high income levels that are available. So your typical A-REIT is probably delivering you about a 5% yield at the moment, which is pretty good. Total returns have been great. So if we look at sort of the last sort of 10 years ending December last year, you're talking about an average return of about 11%, which is very strong as well. Diversification. So, there's lots of choice for investors. Not only can you invest in REITs which have office buildings, shopping centres and industrial facilities, but these days there's additional alternative sectors like childcare centres and even service stations. And maybe the last thing to round it out is just that underlying intrinsic tangible value you get from the real estate, which is nice, I guess, in this day and age of tech stocks where some companies may have no profit or maybe even no revenue.
And so you touched on something as well, Jonathan, that I guess A-REIT's been listed on the stock exchange are liquid. And look, when I talk about a lot of the direct funds today, they are unlisted. So I guess investing in A-REITs does provide that additional liquidity. Can you maybe give us, our audience here, a bit more colour on how the A-REIT sector's placed, say, against the more broader general equities markets?
Yeah, sure. Looking across the A-REIT sector at the moment, it's had a great year. And you've seen a lot of share prices bounce back strongly. Fundamentally, also, we're seeing improvements in rent collections. We're seeing earnings upgrades, distributions upgrades. We're even seeing managers buy back their stock, and generally that's a sign that there's good value there. But when we look at valuations in the sector, we see really good value. So firstly, from a traditional PE perspective, A-REITs look pretty good, probably cyclical lows versus general equities. And also, if we look at them in terms of the yields that you're getting versus interest rates, they look pretty attractive as well. And the last point really is about looking at them versus their net tangible assets. There's plenty of REITs trading at discounts, and when you see that, to me, that generally signifies value.
So you brought in some technical terms there, Jonathan. PE, price earnings multiple. It's probably a good lead into the next question I was going to ask is, what's the benefits of hiring a professional in this space to pick stocks versus, as you said, they're listed. Theoretically, anyone can go and buy and sell them themselves. Why would you potentially hire a professional in this space?
Yeah, look, the sector is always evolving. And, as a manager, we spend a lot of time obviously understanding themes and what's changing in the sector. And I think that's the key difference. And if you think about one of the key themes at the moment, it's the growth in e-commerce. That's having a huge impact on different types of real estate. So on one hand, you've got the industrial warehouses where if you buy something online, it's going to go through a warehouse before it gets to your house. And they're doing really well. Those prices are being really well bid for. At the other end of the spectrum, you've got the traditional sort of discretionary malls. Think Westfield shopping centres. They've been incurring falling rents, rising occupancy and falling values. So if you would invest, let's say, in an ETF, which is basically buys the index.
An exchange-traded fund?
Yep. Leading into COVID, you would have been very overweight those discretionary malls, and that would have really hurt you through that COVID period. Whereas as a manager, we've been quite underweight that sector, and we've been able to navigate that period very well.
Okay. And so I guess you apply the expertise not just of yourself, but the broader team at Charter Hall. Maybe if you can give our audience a little bit more detail on how the Maxim A-REIT fund actually works in practice.
Yeah, sure, Steve. It's pretty straightforward. Think of your traditional managed fund which invests in shares. The Maxim fund's very similar, but in our case, we own listed property companies. We mark to market our investments every day, so we calculate a daily unit price, and we offer daily liquidity in terms of applications and withdrawals. We also deliver quarterly distributions to investors. But I guess at the end of the day, the thing that's really what we're trying to achieve is to beat our benchmark total return, which is the A-REIT index. And I can say successfully we've been able to do that over a 15-year period.
And look, you saw the slide I put up before Jonathan joined us with the performance. I should also highlight that maximum performance is on an ex fees basis, so after all fees. That's the only way we show our returns at Charter Hall, because ultimately it's the after fees returns that investors receive. And you can see on that basis, Maxim, even the last 5 years, has significantly outperformed the benchmark. But look, as I always say at these kind of things, past performance isn't any guarantee to future performance, and always read the offer document in full. Look, thank you very much for joining us today, Jonathan. That gives us a great update on what's happening in the Australian AREIT sector, as well as touches on some of the key points around the Open for Investment Maxim Fund. Thanks, Jonathan.
Thanks, Steve.
That was a terrific update from Jonathan, who provided his insights into the listed property securities market. I'm now going to cover off the Direct Office Fund. For many years now, it's been our largest fund at $2.4 billion. You can see up here on the screen, the top 5 tenants continue to be extremely well credentialed. This is part of the reason why across the suite of funds at Charter Hall, the income continued to be resilient and the returns performed strongly even through this pandemic. When you have government entities, Western Sydney University, Suncorp, Westpac and Horizon accounting for almost 60% of the income, you can see why those income returns for the Direct Office Fund continue to be resilient. I'd also highlight that our occupancy rates are above the PCA, Property Council of Australia, benchmarks for both of our office funds. And as you've heard me many times before say, we focus on WALE, weighted average lease expiry, and DOF benefits from over an 8-year average lease term. The next fund I'll talk about is another office fund, the PFA Fund, which is now a $1.8 billion fund which focuses heavily on government tenants, that is federal and state governments, who now account for more than 54% of the net income. What I would also say is that the PFA Fund has bought some fantastic assets during the quarter, but I will touch on those more later on in today's presentation. The PFA Fund is a little bit different to DOF in that it pays distributions to our investor customers every month, but like DOF, it has a very robust tenant base with government, American Express, Horizon, Lion, and the New South Wales University. So our 2 office funds in DOF and PFA have continued to show very robust returns throughout the pandemic. But now I'll talk about the Direct Industrial Fund number 4, which is our Open for Investment Industrial Fund. It continues to grow strongly and benefits from a very strong transaction team that we have at Charter Hall, meaning that we've been able to source many acquisitions in an off-market basis and utilising relationships we have with corporates, tenants, and the agency world. It benefits from over a 10-year weighted average lease expiry, pays distributions to our clients on a quarterly basis, and has nearly a 100% occupancy. That's fantastic because every time you have vacant space means it's lost income that we can't pay to our investors. During the quarter, we made an acquisition which was the Kmart distribution facility up in Brisbane, Queensland, and you can see now that Kmart now represents the largest tenant by net income in the fund. Other strong tenants in the top 5 include Ingham's, Visy, Mainfreight and Primo. What I would also add is that the Direct Industrial Fund number 4 is a very diversified fund with over 25 assets spread geographically from Perth in WA, New South Wales, Victoria, Brisbane and Adelaide. That's terrific because we've got a great spread across the country and a great diversification by individual tenants. I'll now talk about DIF4's most recent acquisition. So despite it technically falling outside the March quarter, I do want to provide our investors with a timely update. These 2 properties are both leased to Paddy's Foods. It's 2 assets with a combined value of $141 million. They benefit from 30-year leases as well as having fixed 3% rental bumps. We like this because it provides that security of income over long periods of time, which helps us underwrite the quarterly distributions that DIF4 provides to our investors. The next fund I'll talk about is the Charter Hall Direct Long WALE Fund, or we love our acronyms LWF. It provides distributions on a monthly basis and has 7.6-year average lease term. Again, like all our funds, the occupancy rate is extremely high at 96%, and the major tenant, being 25% of the net income, is Bunnings, as well as having Telstra, Woolworths, and some other food manufacturers in the brands. The benefit of having these consumer staples tenants is that they're very robust and will go through different economic cycles. And part of the key reason why we launched LWF was that many of our investors told us that they want a diversified fund. So far I've talked about sector specifics, whether it's a REIT fund, an office fund or an industrial fund. Many of our clients don't want to have to pick the sector. So this is a diversified fund which is across different sectors such as social infrastructure, industrial, convenience retail, as well as the hardware or Bunnings tenants as well. The final fund I'll talk about before our second guest speaker joins us is the Wholesale Property Series number 1, or WPS1. It's only available to wholesale clients and has a very high minimum entry point of $250,000. The reason why we created this product is to make some of Charter Hall's best ideas, investments in wholesale and our partnerships available to our high net wealth investor customers. You can see here that it's spread with a heavy focus initially on the industrial and logistics and the social infrastructure and diversified sectors. It will continue to be open for investment until February next year, at which point it will close. For those that aren't familiar with the fund, it launched in February last year, and so being able to provide our investor customers with a 12.6% return in the middle of a global pandemic is something that the team have worked very, very hard to achieve. It's something we're very proud of. I'd now like to introduce our final guest speaker, Anna Maris, the Regional Portfolio Manager in Charter Hall's Industrial and Logistics team. Anna is a specialist in the sector with over 20 years experience across roles including Goodman, AMP Capital and TMX. Anna oversees the performance of facilities, property and asset management teams across a combined portfolio of valued in excess of $4.2 billion, with over 100 tenant customer relationships. Anna is going to provide some insights into the industrial activity driven by retail and the boom of e-commerce. Please welcome to the stage, Anna.
Thank you, Steve, for the introduction and the opportunity to talk about the industrial and logistics property sector. The Charter Hall Direct Industrial Fund number 4, or DIF4, continues to grow in line with its strategy to invest in long-leased industrial and logistics property. So it is my pleasure to take you through some of the key thematics influencing this part of the property industry and how the asset class aims to continue to provide sustainable and stable income through typically long-term leases with strong tenant covenants in industries that are being positively impacted by the consumer's change in buying patterns. The industrial and logistics property sector has been the beneficiary of change in consumer buying behaviour and a significant rise in e-commerce and online channels, which is positively impacting industrial demand. Vacancy rates are cyclically low across the nation, with the New South Wales industrial occupier market remaining the tightest. That is the lowest vacancy rate of any in Australia. Strong leasing fundamentals continue to shift vacancies in the sector as the digital trends sustain activity and property fundamentals. Industrial funds within the Charter Hall Direct portfolio have exposure across the eastern seaboard to major occupiers such as Australia Post and Woolworths, who have shown resilience through COVID and in fact recorded significant growth as businesses. 2020 was an above-average year for gross take-up in the over 5,000 square metre category in Sydney market, with over 1 million square metres of space leased. Demand was primarily driven by the growth in the retail trade sector, which accounted for 45% of gross tenant demand. Retail groups are expanding their industrial footprint to cater for growing online penetration. Saying that, leasing fundamentals also remain strong as the logistics and warehousing sector played a significant role in providing essential infrastructure for the reliable distribution of goods. The improving depth of the industrial tenant occupier market is evident in the strong outperformance in comparison to the year following the global financial crisis. Third-party logistics and e-commerce businesses make up approximately 68% of all major warehouse transactions in 2020, with every additional $1 billion spent equating to an additional 85,000 square metres of industrial demand. In fact, e-commerce fulfilment requires 3 times the footprint of a traditional retail occupier, again driving further demand in the sector. In summary, the underlying real estate fundamentals for the industrial and logistics property market remain strong and support a positive valuation outlook. The Charter Hall Direct Industrial Fund Number 4 has significant expertise and a strategic real estate portfolio to generate opportunities in this ever-changing operating environment. Thanks for the opportunity to talk to you about the market, and back to you, Steve.
Thanks for that, Anna. And what we always try and do at these quarterly events is showcase the expertise that is within the Charter Hall Group. So hearing from Anna on the industrial and logistics markets, hearing from Jonathan on the listed property sector, allows our audience to learn more and more about the subsectors of the property market. This now brings me to the next slides, which will talk about Charter Hall's access to sale and leaseback. In the last 5 years, we've done over $10 billion of sale and leaseback transactions. This means partnering up with people where we take on the real estate, we usually get very long-term leases, and the tenant customer gets capital or gets to exit a non-core part of their business. We've done some leasebacks deals with some very large tenants, and you can see here up on the slide, Western Sydney University, Coles, DHL, Telstra, Bunnings, to name but a few of the brands you can see there. But why do we do sale and leasebacks? How have we at Charter Hall been able to access this part of the market better than most operators in the market? Well, it's because we are fully integrated in terms of the expertise sits within the Charter Hall Group, from capital transactions, legal, the tax outcomes, finance, so underwriting through debt, and the development expertise means that we can provide an all-of-business solution when we're dealing with these corporates, helping them and helping our investor customers access quality assets on long-term leases. So $10 billion in a 5-year period is something we're very proud of across the group. But the tenant relationships are really what allows us to do this. And you can see here the top 15 tenants across the group account for approximately 54% by net income. The blue represents the office sector, the orange industrial, green social infrastructure, red the retail. So because Charter Hall does play in all the core real estate sectors, it means at many different touch points through our organisation, we're dealing with the tenants. So we understand their needs, we're flexible, we're adaptable, and we can move very quickly to deliver outcomes that suit the tenant customer, which means we're able to access that quality property which our investors desire. So sale and leasebacks is one part of how we like to access some of the best real estate for our funds at Charter Hall. Up there on the screen, you can see 4 most recent acquisitions that occurred during the March quarter. And they span 2 of our open for investment funds, being PFA and DIF4. But what they all have in common is the quality of the real estate, the length of the lease terms, the occupancy rates all being 100%, and some major tenant strength there with the University of New South Wales, the federal government down in Adelaide, Kmart, the distribution centre, which I mentioned at the start of today's seminar, as well as South Australian Health down in Adelaide. Being able to unlock these acquisitions for the funds is something that we do work hard on. We've got a very large transaction team, we've got fund managers, we've got asset managers on the ground, and through all these relationships, we work and make sure that the assets that are coming into the funds meet the investment mandates and are able to deliver those long-term income streams that our investors value. So I've talked about recent acquisitions that meet the investment mandates of our open funds. But the sign of a good manager is knowing when to sell, and when you do make that decision to sell, unlocking value through that sale process. You can see up here on the screen the 3 most recent sales that occurred during the March quarter. The first being DIF2's sale of an asset in Campbelltown, New South Wales, which transacted at approximately a 5% premium to the 31 December book value. Additionally, DAT1 and DAT2 sold off their final assets during the March quarter, both at premiums to the book value. So this is a testament to Charter Hall's discipline. We're not an accumulator of assets where we think it makes sense to sell an asset or where an asset needs to be sold. We make sure we deliver on unlocking that value. Thank you for joining us today. If you'd like more information on any of the opportunities that are currently open for investment, you can visit our recently launched Advisor Resource Centre at www.charterhall.com.au/advisor centre, or please do contact one of the Charter Hall team. Our team are focused on adding value to all property portfolios and delivering on the fund's investment goals, and will continue to do so for the benefit of all investors. Thank you for your ongoing support of Charter Hall.